On behalf of SFU, I'd like to acknowledge that we are on the unceded territories of the Coast Salish peoples. And I am, at this point, I'm just going to turn it over to Chris. And then I imagine later in the session, we're going to go into some breakout rooms. So take it away, Chris.
Sounds great. Thanks so much, Allison. I really appreciate the kind words and introduction. And absolutely, yeah, we're going to be, we'll talk about that in a little bit. We're going to have a breakout room session as well as a bit of a recap and presentation. Again, for those of you who missed our session last week, it was recorded. We have a webinar link online. Also, really encourage you to attend another session later this week, Thursday at 10 a.m., July 30th, presented by Garibaldi Capital. And they will talk a little bit about pitch deck and your financial story as it relates to raising capital. I mean, again, a big part of my message is about the fact that, look, you as an entrepreneur should be looking at a pro forma long before you're thinking about raising money. Because it's a critical tool to help you establish and determine your viability, and it helps you model out different strategic growth scenarios. But of course, the reality is it does become a critical part of your due diligence when it comes time to raise capital. Garibaldi Capital will talk a little bit more about what investors do look for in that story. And then thirdly, really excited to announce that WEC we'll be hosting an Ask Give webinar presented by Paulina Cameron from FWE. That's going to be on Thursday, August 20th at 11 a.m. So another bit of content we'd encourage you to take advantage of. So those are upcoming events. Next piece. A reminder, by the way, for all of you attending the programs, look, we're making a point where we can, and as often as we can, especially during these tricky times with COVID, of hosting events, content, programming like this to really equip you and train you as entrepreneurs to get on top of your game. Ultimately, though, we have a community membership program at VentureLabs. And for those of you who are starting to evolve, getting further along, getting close to market entry or scaling, we have an opportunity, you have an opportunity to join as a member where we assign you a lead mentor that you can check in with 1 to 2 hours a week. And this enables you to have a bit of a confidant and advisor where you can do deep dives on any issue that may arise around, marketing, sales, revenue modeling, pro forma, as I'm speaking to today. It's a great way to just sort of stay on track, get a second opinion. Ultimately, that can lead to introductions in the market and help you, of course, navigate fundraising if that turns out to be a critical part of your story. We will be having our next comprehensive program on market validation training in the fall. And then beyond that, just always go back to our events calendar, which Allison actually, who just introduced me, she's the gatekeeper for all that good content and updating our webinar list. So be sure to check that out. Now, as Allison said, look, I'm going to be running through a bit of a quick recap on everything we spoke about last week. I'm also going to get into the third and final case model, which is B2C e-commerce today. That's probably going to take up the first half of this session. But then what we're going to do is we're going to set up some breakout rooms, specifically across those 3 case models. So Dave Thomas will be leading device, albeit tackling software as a service. So for any of you on the line who are specific to software as a service, you're welcome to join me. And then with B2C e-commerce, we have Floyd, another one of our EIRs, who will be leading that conversation as well. Most of you, I think, informed us in advance which room you want to be a part of. If you have not, please make a comment in the chat line, and Pauline, who's helping to administer this event today, she'll make sure you end up in the right room. And then one more time, just to see how much of a mix we have across the different growth stories. We ran this poll first thing during our last session. Pauline, don't know if you want to launch the same poll just to get a sense of who we have online. And one other thing I'm going to comment, folks, I apologize. Last week, I foolishly left my phone on, which is coupled to my computer. So there were some rings and bell tones that came through. I've shut off my phone. My one challenge, unfortunately, is that I'm a Mac user without a mouse. So I apologize because sometimes when I navigate the keyboard, I know you can hear the keystrokes come through. I know that's a bit distracting. I apologize for that. It's on my checklist to get a mouse, try to make this a little bit easier for everybody. Right. So again, look, we've got a mix similar to last week. We've got a group of, we've got quite a few folks at the startup phase. a number of participants a bit later on in their growth trajectory, perhaps looking to scale. And then also thanks for the advisors and mentors joining us today as well. Quick recap again, Chris Stairs, EIR at VentureLabs, although I do wear hats at a number of different organizations, SFU VentureLabs, but also a mentor at SFU Venture Connections. I provide sales and marketing support for early stage startups through Canada Startup, and I'm a financial advisor with the Volition team as well. So wear a number of different hats. There was a day, however, when I was directly involved in a technology startup about 10 years ago, and that's where I first learned the importance of money modeling and building out your pro forma and really starting to focus on your numbers fast. And so that's part of the expertise I try to bring to the table here at VentureLabs. And let me just close out the poll here. The big message from last week, and again, as I said before, why do we focus so much attention on the pro forma, and when should you be building this out? Well, again, if there's one message you take away today, pro formas are not exclusively about raising money. They're not just a tool that's used during the due diligence phase with investors. Money modeling is an exercise you should begin immediately upon starting your venture. As soon as you have an idea, you want to switch gears back and forth and start thinking about, well, how do I actually generate revenue? What's my pricing strategy here? What are the different cost structures I need to consider? What is the potential profit that I could be making? We talked a little bit about the design of the pro forma. It's typically a 5-year, what I call a 5-year cash budget, forward-looking. And another point I just wanted to make, I know with all of my examples that I've been sharing, there are actually only 3-year pro formas. I've done that really for simplicity's sake and to ease the burden. It takes a bit of effort to model out these mock-ups. And really, I wanted to demonstrate 3 years because that's typically, not in all cases, but often you want to hope and assume you're getting the cash flow positive by your 3rd year at the latest. There are certainly exceptions depending on the business you're in. So that was the point of the illustrations I've been giving you, but ultimately you do want to make this a 5-year projection. And then what are you illustrating in that 5-year cash budget? Well, it's 3 things again. The first thing it requires you to do is numerically describe your business model and all its moving parts. It's a growth story. So again, it's a 5-year time frame, which means that it requires you to start thinking about your sales trajectory and your revenue projections. It then starts getting you to think about economies of scale you may be able to achieve with your operations. And then that leads to discussions about profitability, how much and when, and when do you become cash flow positive. And last but not least, it's critical for sensitivity analysis. It enables you to start, once you kind of lay down the foundation and your initial assumptions, it enables you to start running different scenarios to understand what could happen to the business under different circumstances. Just to dive in a bit more quickly about those 3 points. Again, business modeling, one of my messages are always keep it as simple wherever and whenever you can. And truth be told, when it comes to describing business, I've really discovered it boils down to 3 core functions. Sales and marketing, which is all about the activities to acquire your customers. Then there's operations, which is about sustaining the capacity to serve those customers. What's the back engine that you need to get that done? How much is that going to cost you? And then last but not least, finance, which is really about understanding cash flow and understanding how to manage your cash volume and cash shortages during trickier times. So step 1, you've got to attach numbers to all of these. Step 2, understanding your growth story. And again, the good news is that where all your business models tend to vary quite a bit from, say, a device manufacturer, software as a service, B2C e-commerce, where your business model and your pro forma design will certainly vary. The overall growth story you're aiming to illustrate is quite often the same. And it's something you understand for your own sake, but it's also the kind of story that eventually leads to your pitch conversation with investors. 6 key components, your unit economics. You understand precisely how you make a profit off a single transaction and or how much of a profit you make off the extended lifetime of a customer. The second one then is understanding repeatability. Okay, well, that's great. I understand how to make a profit off a single transaction, but how many of these transactions can I potentially achieve over time? In how many markets? Which is my beachhead. The third and most critical milestone in your early years is understanding exactly when you become cash flow positive, and when you become profitable. And we talked a little bit towards the end about the fact that those are actually quite often two different things and can occur at two different times. You can record a profit on paper, but there can be delays on when you actually receive cash. And then similarly, there are situations, especially if you're in a manufacturing play, where you suddenly need to cut checks in high volume out to material suppliers and manufacturers, which means the sequencing of when your cash comes in and out of the organization could be very different from when you're actually recording a profit. So you need to be mindful of both those milestones. Fourthly, once you hit cash flow positive, the real story is, well, how am I scaling? What's my growth trajectory? What are my growth multipliers? And these get into discussions about how you're leveraging channel partnerships to really push out volume into the market as quickly as possible. That's going to be critical to today's case model. Do you have market exclusivity? Once you bag a customer, how can you extend the relationship with that customer and try to find ways to increase the revenue over the lifetime value of that customer? Are you patent protected? Do you have a window of time where really there's minimal competition? Story point number 4, capacity constraints. Once you start looking into the growth metrics, you need to understand, well, where could I run into constraints? And how do I start determining my economies of scale? And then last but not least, again, all this then boils down to, well, how much cash do I need to really get things off the ground? And is there any seasonality to my cash flow cycle that I need to be mindful of and need to make sure I have cash reserve to protect myself in those times where I am actually being drained significantly. And then the third point, sensitivity analysis, a reminder of our good man, Commander Chris Hadfield, and his philosophy that you should always be thinking about the next thing that could trip you up, the next thing that could kill you. And really the reality is it's about once you've built the pro forma, you're running all sorts of different scenarios all the time, both to get a sense of your growth, what I call your growth levers and growth opportunities, but also again to identify where your financial vulnerabilities could be. The sooner you do that and well in advance, the sooner you have an opportunity to consider the strategies to mitigate that potential risk so that it doesn't really become a risk in the first place. You're able to avoid some of the greater challenges. So as I said before, the goal is for you and your own sake is to understand your numbers, to get nimble with those numbers and use those numbers to really help you make strong strategic decisions. And you're doing this long before you're thinking about talking to an investor. So that's the recap from last week's session. What we're going to do now is we're going to jump into our third case model, and it's B2C e-commerce. And I'm going to suggest that, you might actually be a sole proprietor artisan, for example, and you're thinking about some apparel or jewelry, knickknacks of some kind. If you're in the e-commerce space with us today, and that doesn't apply to you, that's okay. What's more important is the economics and the metrics that I'm going to be running through are going to demonstrate really how you need to evaluate the numbers behind your business. And I think you'll find that the process we go through is going to be universally applicable regardless. I am just going to switch gears now, and I'm going to open up the spreadsheet. Give me one moment here. Okay. Pauline, if you could do me a favor and just let me know if you're able to see a spreadsheet.
Hi, Chris. Yep, looks good.
Fantastic. Okay, we are going to basically run through the exact same flow and sequential order as we did with the last two case models. Today, we are talking about the super cool accessory company, and we're looking at the first 3-year summary of the pro forma. And we're going to pretend that we've got an artisan locally who's gotten really excited. They're fantastic at jewelry, and they're actually targeting this specifically for young girls between the ages of 7 and 14. Lovely design, gotten fantastic feedback, been selling them at local market fairs and thinking, you know what, like I really want to put a proper engine behind this. And I think there's an opportunity for me to, take this somewhere. So we're going to kind of walk through, well, what does that look like? And it doesn't need to be jewelry. It could be any number. It could be any kind of a consumer good that you want to get out into the market in volume. Well, we're going to run through a certain sequence of questions that will help us discover, well, what is the money model behind all of this? just as we did last week, we're going to start with sort of a general 10,000 foot overview. And we're going to say, okay, well, this particular scenario is telling me that when we launch, by the end of the year, we're going to be selling about 10,000 units into the market. But by the third year, we're aiming to get over 200,000 units in the market. Total revenue is going to rise from about 100,000 upwards of 1.75. Now, interesting, because we're seeing two things that are going to really already, I'm looking at two things that are going to sort of tip off some concerns or red flags. First off, that volume is significant. 200,000 units by the third year. That is nothing, that has no comparison to the other two we looked at. In the other two cases, we were looking at selling device or software, and we were getting into the thousands. In this case, we're talking about hundreds of thousands of units. And we're also noticing that the gross margin here is quite low. It's at about 25%. And I'm gonna start asking myself, well, why is that so low? And when we get into the unit economics, you're gonna start to appreciate why that is. Now we're gonna jump down, we're gonna look at fixed costs. Now, another part of the story is really, this is a sole proprietor that may be leaning by the second and third year on some operational assistance. There may be some part-timers helping out. They may be outsourcing some digital marketing. But as we scroll down, we're going to see total expenditures, overhead, fixed costs, some part-time salaries, so forth and so on. This is a relatively low annual operating budget, starting out at about 250,000, maybe approaching $500,000 by the third year. And these are all based on a number of hypothetical assumptions. The message here is that unlike the other two case models, this is a relatively low fixed cost budget. However, if we scroll down, let's check out the net earnings. What we've discovered is even after 3 years, and even after cranking out 200,000 units by the end of the third year, we're actually still recording a net loss of about $45,000. Now, why is that? And again, I've made a series of assumptions, which I'll run through, but the message, no big surprise, the message we're eventually going to get to is that whenever you're selling something at a low margin, it's the classic high volume, low margin play. If you are selling something that's seeing a relatively low gross margin, then you need to get into volume, and you need to get into volume fast. But let's switch gears, look at unit economics, and understand why are those margins so low. And what I'm going to walk you through when it comes to B2C e-commerce is whenever you're selling any consumer good, the reality is you have a number of choices as it relates to your retail channels. And I'm just putting up four scenarios to give you an idea of how they vary and what your gross margins look like by the end of it all. The four that I'm going to put in front of you are column E, direct to consumer. This assumes if you're sort of an independent artisan, I mean, it's very inexpensive to set up your own website, subscribe to something like Shopify, start spending a little bit of money on digital marketing, and see if you can just sell these things online 1 to 5 at a time. But the other channel options for you are, you could start selling in volume direct to retailer. And again, this is sort of children's apparel, children's jewelry. So your options are Toys R Us, Claire's Jewelry Store, Granville Island Toys, or you could get into some of the bigger game like Walmart online. And there's a bit of a difference between direct to retailer. I'm specifying brick and mortar, which means you're actually shipping these directly to a retail store that exists somewhere on a street. People walk into that store, or direct to retailer online. Walmart has storefronts, but they also have a very large online presence. And in many cases, consumer products are pushed through the online market. The fourth scenario is to actually drive this inventory through wholesale distributors. Because in many instances, the big box stores, and Walmart is actually one of these stores, Walmart doesn't always deal directly with the manufacturer. In fact, they prefer to deal with wholesalers that specialize in different product categories, including apparel, electronics, shoes, toys, books, what have you. And in some cases, you actually have no choice but to go through the distributor to get into the retailer. But you're going to see very quickly that it's really important to start thinking about these other channel strategies, because again, the key message coming out of this is that you're going to need to start pushing this stuff in volume. And the likelihood of you being able to do this as an independent artisan is pretty slim. But let's now start looking at these unit economics. What we're going to say is that this piece of jewelry Suggested retail price is $19.95. But the reality is that under different scenarios, that as the manufacturer is not necessarily what you're going to be charging or what you're going to be getting in the bank. And I'm going to start with the two channels in the middle first, and then show you how the other ones differ. So sorry, column C and D, direct to retailer. The reality is, and most of you are probably aware, that in a retail situation, there's usually 100% markup when a product hits the store, Lululemon or Ritzy or what have you. The reality is they're going to, whatever they've paid to get it into the store, they're going to at least double that. So another way of looking at it is if you're selling this piece that has a regular retail price of $19.95, you're actually going to be selling it to the retailer at half that. In this case, it's $9.98. So that's the first point you have to bear in mind. But then you need to figure out, well, what are all the direct costs per unit that I'm incurring with this single $9.98 product? Well, in the case of consumer goods, it begins to add up. It may look like nickels and dimes in the beginning, but by the time you get to the bottom, it's a significant amount of money. Now, we're going to say, first off, material cost, manufacturing and assembly and packaging at the factory. We're going to pretend you're getting into volume. You're doing this overseas. Well, in earlier years, when you can't guarantee high volume, you may be looking at $3.18 per unit to have this thing manufactured in China. Then, very much like with the device scenario, you've got overseas shipping, you've got duties and tariff when it hits the border, but then you've also got warehousing and freight forward, because the reality is you're going to need to manufacture in volume in order to see some sort of economy of scale on your costing savings. But you may not have negotiated all the deals up front yet with Toys R Us, Claire's, Granville Island, and Walmart. You may need to manufacture and get those brought over to North America while you're in the process of selling into these big stores, which means you're going to have to warehouse these units somewhere. And then when you close out that deal with Toys R Us for the next 3 months, you've got to freight forward it to Toys R Us. So that all boils down to a per unit cost. Then you've got one other item, and I'm going to introduce you, and this is something that you actually want to pay very close attention to. There are actually, call them brokers or sales agents out there who make a living off finding the next exceptional product out there. And what they will do, you can contract them. They will help you sell into the retailers and the wholesalers and distributors. And the fact of the matter is that's something you seriously want to look at, because they've got all the relationships in advance. If they get excited about your product, they're going to be set. They know exactly who to call. They know the purchasing agent with each of those stores. They know the purchasing cycle, because typically with these big box stores like Walmart and Toys R Us, they're usually purchasing inventory on a quarterly basis. And you got to know exactly when to hit them up for the next order of children's jewelry. Well, that sales agent is going to know exactly who to call, when to call, and if they're excited about your product, they're going to sell for you. And the reason why is because in this case, they're going to get 5% commission on each unit that they sell into Walmart or Toys R Us. So these are people, they're out there. It takes a bit to find them, but these are professionals that you want to tap into. But again, that's 50 cents commission per unit. So when you add all this up, you're actually against a $9.98 purchase by the retailer. You've got about $7.43 in direct costs. So your gross profit per unit is $2.55, which is only 26%, which is fairly low. Now, heads up, that's actually relatively high in the world of consumer goods. I have a little note over here, line number 28, and I've spoken to a few experts in the field. The reality is that you are usually quite happy as somebody who's manufacturing consumer goods if you're getting between 17.5% and 25% gross margin on a wholesale transaction. That's actually the target you're shooting for. So very different from the world of device, where you're kind of aiming between 50 and 75% before channel partners get involved, right? So these are somewhat universal metrics that you're targeting for. Now I'm going to quickly switch gears, and I'm going to look at how wholesale distributors might be a little bit different. And then we'll look at direct consumer. Wholesale distributor. Now remember again, if you work through a wholesale distributor who actually works with any number of these retailers, one distributor may be servicing Toys R Us, Claire's, and Walmart all at once, which would be a fantastic conversation to have, because that one dialogue is immediately allowing you to leverage and access multiple retailers. Well, they need to make money as well. And typically it's a 25% commission off what the retailer is paying. So in that situation, you're actually selling into the distributor at $6.48. Well, again, if you run through all the other direct costs that you're dealing with, $3.18, $65 shipping, another 60 cents on tariff, you're paying 32 cents to the sales agent in this instance. There is one difference. You're going to notice there is no warehousing and freight forward. Well, that's because it's the distributor who's taking on that responsibility. They're going to buy it directly from you as soon as it hits the port here in, say, Vancouver or down in Los Angeles. They take possession. It's then their warehouse and their freight shipping logistics that they're sorting out. So that's part of the reason why you're not getting as much from the distributor when you're selling them per unit, but then again, you're not incurring as many of these direct costs. But at the end of the day, if you look at line 24, you're walking away with $1.73. Now that's still the targeted 27% gross margin, but it's $1.73 per unit. Okay, now all of you are probably starting to realize, holy cow, this is why I need to be selling hundreds of thousands of units in North America in order for this to even make sense and for me to make some money. Now, the one last point I'm going to say, though, is at this point, people are going to be like, whoa, wait a minute. Why don't I just sell direct to consumer? Because then I can charge $19.95 and hopefully keep a whole bunch of that money. Well, just a few other things you need to be mindful of. If that's the route you take, first off, let's run through all the direct costs again. You're looking at $3.18 per unit for manufacturing. You're paying for shipping. You're paying for duties. Again, you're responsible for warehousing. Now, there isn't freight forward because you're not shipping these to a retailer. Instead, you're shipping them one at a time to consumers. But here's something else to consider. You'll notice that I have a line item here called consumer shipping. And what I'm going to propose to you is that to ship one of these in North America, let's say you've got a warehouse in Winnipeg and you've got a buyer down in Texas. Well, the reality is to ship one of these from Winnipeg to Texas could cost the customer $4.95. And that's on top of the $19.95 that they're paying for the piece of jewelry. Well, different consumers think different ways. But when I run into that scenario, I'm like, well, wait a minute, why am I ordering this online and paying another $5 when I could go down the street to Toys R Us and buy this thing for $19.95 and avoid the $5 shipping? So quite often what a lot of entrepreneurs are unaware of is that merchandisers will actually subsidize some of the cost of shipping. And I have an assumption, if you scroll down a little bit lower, where the actual shipping cost to the consumer is $4.95. But I'm actually going to charge this. I'm just going to charge the customer maybe $2.50 in shipping, and I'm going to subsidize the rest in order for the overall price point between the retail item and the shipping to still be palatable. So I'm not being cannibalized by some of the other channels I may be using. So that's a bit of a trick you need to be mindful of. But here's the big one: you've got to remember that if you're selling direct to consumer and you've set up your own website. And you're subscribing to Shopify and you're pumping this out one at a time on the internet, nobody knows who you are. You've got to establish your brand. You've got to get this image in front of everybody. You are going to be leveraging digital marketing, social media marketing, and search engine optimization in order for people to be even aware that you exist. Because normally when I shop for jewelry for my daughter, I'm going to go to Toys R Us or Claire's, or I might check out Walmart, because as a consumer, that's what I'm trained to do. So now you have this expense, and I'm just approximating it at $7.50 of customer acquisition costs in order for you to actually get my attention, so that I'm buying this piece of jewelry off your website and not going to Claire's jewelry store. So when you add all that up, all of a sudden you're looking at total direct costs on average per unit of $15.66, which now means, yes, you are walking away with $4.30, not say $2.55, but your total gross margin on $19.95 is still down to 22 cents, and you're really only making $4, which means you still need to sell hundreds of thousands of units for this to kind of make any sense for you. So my message,
Chris?
Yes.
Sorry, it's Pauline. Sorry to interrupt. I just want to let you know that a couple of questions are coming in. I didn't know if you want to address them now or save them for the rooms later.
You know what? I'm nearly done this particular example, and but then I could maybe answer a few of them quick and then flip it over to Floyd when he takes over the room. I know we're already at 10:35, so does that sound okay? I'll just wrap up and then we can jump into the questions.
Sounds great. Thank you.
Okay, thanks, Pauline. I appreciate that. So look, I'm going to be honest with you. I've only modeled out a couple of B2C e-commerce scenarios, but I did happen to do one for, it was youth apparel. It was actually a teething solution. And when we got into the numbers and when we worked with a particular sales agent, I mean, the numbers weren't like exactly like this, but the channel realities and the margins were very much like this. And we discovered that we needed to get into high volume, which is why from a sales modeling perspective, you're going to see this is my 3-year forecast over time. And again, one of the other reasons why you want to work with one of these sales brokers is because they understand the volume by month for each different product category that an outfit like Toys R Us or Walmart typically orders. They can actually help you kind of understand what the appetite is going to be for each of those retailers and distributors, which is critical information to help you kind of forecast your overall sales volume. But the reality is you're going to see in my instance, I'm going to say that once you get into volume, 90 to 95% of the volume you're pushing in the market is going to be very much through your channel partners. Last thing I'm going to sum up. Sorry, we're going to go back to the pro forma. So the big message here is when you run the numbers, you realize, well, look, to break even in this particular scenario, you're going to need to push about 225,000 units per year. And this is when you want to switch gears and look back at your TAM, SAM, SOM. And I did some quick math. This is by no means perfect science, but I kind of did an estimate based on the populations of Canada, the US, and Mexico, and roughly what percentage are girls between the ages of 7 and 14. And the reality is you're looking at a total potential addressable market of about 20 million. And I'm sort of saying, well, look, if you get 3% of that, you're looking at about 600,000 potential buyers conservatively. Well, again, you need to sell 200,000 of these a year to break even. Those numbers look a little dicey, to be honest with you. And the turnover, I mean, yes, maybe every year you've got another 100,000 girls who are, turning from 6 years old to 7 years old, and they're starting to look at this kind of jewelry. But I mean, that flow in terms of your volume, that's not a big volume, which immediately gets you thinking about, well, how do I get into Europe, Asia, and Latin America? I need to really expand this total addressable market. And I'm just going to point out that, okay, this is, one example. Obviously, consumer goods work out well for any other number of products. And just as a point of comparison, let's talk about Lego, which is probably the world's most successful toy brand in history. Well, Lego's a totally different ballgame. And I actually did a little research last night, and it turns out there's 600,000 Lego sets sold a day worldwide. But one of the reasons for the success, and first off, it's an incredibly cool tool, but it's got universal appeal for boys and girls, anywhere the age of 5 to 15. They've got multiple sets. So a single child, the lifetime value of a single child, I can speak to my household. I probably buy 2 sets per year for my daughter. I've been doing that for 4 years. They're getting 8 purchases out of me minimum. And they get into really creative licensing deals, the rights to brand Star Wars, Marvel, Pirates of the Caribbean. So this is a situation where you've got a consumer good where those growth multipliers and your total addressable market is a totally different ballgame. Now, I'm using some very extreme examples here, but I'm just trying to illustrate ultimately for you that, one, you want to build a pro forma, and then 2, you very quickly want to start running sensitivity analysis to understand, well, what is the gross profit of a single sale? Well, in this case, it's going to be anywhere between $2 and $4. Well, common sense is going to tell you that even if you run a shoestring budget, like even if you kept your total expenditures to about $300,000, let's say at the end of the day, you want to walk away with $100,000 to live off of, and then you got another $200,000 to pay for an assistant, you've got accountants to pay, so forth and so on. I mean, that's a $300,000 nut you've got to hit every year. Well, if you're only making even $4 per unit, you've got to be selling at least 100,000 units a year in order to be a sustainable venture. So it's very much a different exercise when you're looking at this. I'm going to step back, and just to close, the larger message here is that it's the creation of a pro forma and the research of these numbers that really helps to illustrate what your economics will look like. And then that will help you to make some very informed decisions as to where you want to take this opportunity or whether you even want to pursue it at all. Pauline, that's
so
it.
Thank you very much, Chris.
I think I hear Dave chiming in.
Yeah, thank you very much, Chris. I think we're going to move to the breakout rooms now, please. If we could do that, that would be great.
Sounds super. Pauline, are you able to set all that up for us? I mean, again, we've got 3 rooms. I think everyone's specified in advance which room they'd like to be a part of.
Yep, breakout rooms are set up. If you haven't requested to be assigned to a room, please send me a private chat and I'll assign you ASAP.
Great. Okay. I think that is it from my end. Unless anyone has any closing remarks or questions, I look forward to keeping in touch. A reminder also, again, in the fall, we'll be delivering a more comprehensive workshop on...
I did have a question.
Yeah, Nabil, yeah.
Yeah, I asked it in our breakout, but I guess it's more related to you. These spreadsheets that you showed, they look very good, and they have a lot of things that let's say I personally missed from my projections. Is that something that you'd be willing to share, the spreadsheets themselves?
The spreadsheets, I tell you what, with the spreadsheets, I mean, here's the thing, Nabil, there's a couple of things. First off, those spreadsheets, every time one of these spreadsheets gets built, it's usually based on very specific assumptions. Mm-hmm. So the message that I delivered in the first presentation is there really is no universal generic template for a spreadsheet. What I encourage you to do is really step back and build yours from scratch, because once you get into the layers, you're going to find that the assumptions I've introduced to those spreadsheets may not apply to somebody else's model.
Okay,
so that's my main message. I'd certainly encourage you to go back to the videos, sort of take a look at how they're designed. But I mean, I'll give you an example with the SaaS model. Look, the last time I modeled out a SaaS pro forma for a client, they ended up using a channel partner. So that whole design, they had their sales forecasting was a 2-parter. They were direct selling, but they had a whole channel partner sales program and forecast that they had to figure out. The unit economics often varies significantly. So the short of it is, Nabil, I think the better thing to do is if you could go back to the video, sort of look a little bit at what I've done, but I'm going to kind of put it on each of you to go through the discipline of building it out yourself.
Thank you. That's good. Thank you.
Yeah, you bet. Any other questions, folks, on any of those 3 models? Otherwise, stay tuned. As I was going to say, there is going to be a comprehensive workshop in the fall on how to build a pro forma. There's also, I was chatting with somebody, Grant Lawrence in the SaaS breakout room, was talking a little bit about performance metrics, which really leads to a larger discussion about sales forecasting. And that's the one topic I've kind of purposely dodged over the last 2 sessions is how do you forecast your revenue model? And what are, the target metrics you kind of have to shoot for in order to be economically sustainable? Well, there's another program that I developed. I call it the minimum viable revenue plan. And that is something that you'll probably see in the fall. And it really gets into how do you reverse engineer from a revenue target? How do you reverse engineer your sales model? And that in turn helps you to really understand how you should be forecasting over a 3 or 5 year horizon. So stay tuned for that. There's definitely going to be some more programming coming out in the fall. I think you'll find a good benefit.
Thanks so much, Chris. I'm just jumping in at the end. Sorry, I've been away for a bit, and it looks like we have some technology stuff that was going on today behind the scenes. Like, Chris, I just want to thank you so much for your time. Floyd, Nabil, thanks for running the breakout sessions as well. Much appreciated.
Will these sessions be recorded, the breakouts? Just wondering.
I'm just back today. I will check in with who's doing some of the support on to see if they did get recorded or not. And I'll get back to you as soon as we got some answers on that, Nabil. Okay. But thanks so much for your time. It's 11:10, and have a great day.
Thank you, Allison. And thanks everybody so much for joining us. It's great. We'll see you soon. Keep in touch.